It's made up of an 8 lot, a 5 lot, a 5 lot, a 5 lot, a 2 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 lot, a 1 lot, a 1 lot, a 1 lot, a 1 lot, up to the total of 93 contracts. So it's not made up of a single contract. Well, that's going to be a Voltic here as well, isn't it? So the vast majority of high volume trades are also Voltic type trades. When you look at this big volume narrative here, is it made up of a single 82 lot candle? No, it's made up of 4s and 2s and 2s and 2s and 2s and 2s and 2s and probably about 70 ones. It's made up of a very, very large number of small trades, all being compressed into a single price print. And that's what a Voltic trade is. It's a Voltic trade is a lot of prices banging against one price point very aggressively. They don't have to be large orders, but the total volume is usually going to be very substantial. When you look at any of these, here's an example on the YM, for example, at the top edge. There's a 51 lot trade there. It's not a 51 lot trade, is it? It's 51 contracts heading into that same area. A 3 lot, a 3 lot, a 2 lot, a 2 lot, a 2 lot, and all the rest are ones. So when you see that trade there, it's a 7 lot followed by a whole stack of ones. When you see this trade, it's all just ones. All of those contracts are just one single contract trades. It's just loads of single contract trades heading into that area of that price print. And then the takeaway from a bottom edge happens. You see a lot of trades heading into this area. There's sell orders and a buy orders. Some of those are big block orders. Look, there's a 33 large block, a 26 large block, and a 26 large block. So there's a couple of large block, individual large block orders heading into that price print. So you can start to recognize some of those areas. When you see that large order at the top edge of the bond, remember that huge order we just discussed on bonds? How was it made up? So at 212s, how was it made up, guys? Well, let's take a look. There is a very large order of 186 contracts. 186 contracts. And then we get a 12, a 12, a 10, a 6, a 6, a 5, a 5, a 4, a 4, a 4, a 4, a 3. So it's a slightly different narrative, isn't it? But it's not made up of a single block order. It's made up of a load of smaller orders all at the same price. And that's creating a very, very big increase in the tick response, isn't it? Well, what is a very big increase in tick? Is it likely that there's a 20,000 retail traders suddenly hitting the button at exactly the same point? Well, no, that's probably unlikely, isn't it? It's likely to be more likely to be an algorithm starting to kick off, doing something. Well, what is the algorithm likely to be doing? Well, it depends what the value is doing, of course. So when we see that the algorithms start to kick off at certain points, so when I see a Voltic algorithm kicking off, for example, here, what is that algorithm doing? Well, we'd already established that the market was bullish on bonds at that stage. So when that algorithm kicks off here, and the algorithm kicks off here, and you're fading the bottom edge, that makes perfect sense. Why is there an algorithm kicking off here? Because it's a stop run. So it's not necessarily an algorithm, it's just the fact that there's a whole load of stops all getting filled as the price breaks. So you've got to remember that if you're a lot of the times you're going to see a lot of Voltic indicators at stop runs, because that's the rapid order flow coming in from all the people's broker accounts that all have stops at those prices. So most stop runs will have a Voltic indicator as well. You'll see that a lot on things like gold. You'll see a lot of stop runs on gold will be Voltic type stop runs. But it's only going to happen if the price starts getting compressed at a single price print, because obviously if you pull away the prices, so the ones that you want to pay attention to is when you start seeing a lot of Voltic indicators not at stop run areas. because it's when Voltic kicks off, that's when the price is getting compressed for some reason. So when you see a price coming off a bottom edge and it has a Voltic, it's highly likely that there's a buy-side algorithm. When the price comes off a top edge and it has a Voltic, it's highly likely that that's a sell-side algorithm starting to kick off, right? So when I look at gold, for example, here, you can see that the Voltic indicator just there is coming off a bottom edge. So that's more likely to be a buy-side program kicking off at that point. Using the liquidity order book, the sells, to try and push the price back down again. There's some sellers coming in here. There's a lot of stuff happening on gold. But because of where that Voltic is, it's highly likely that that's probably a buy-side move. These Voltic indicators here and here, that's a stop run, isn't it? We've just ran the stops against that level, and that's the first liquidity level that's stuck right there. That's the first market maker's real liquidity. So all the buy stops start banging into that one price and get absorbed. So when we see that Voltic on a stop run, it's highly likely that there's going to be some sort of sell response against that, because that's where the real liquidity is, at those prices on a stop run. Does that make sense? So what else do you have? Just here. Same thing, same thing, same thing. Stop run, top edge. Same thing, stop run, top edge. What happens here? Well, the stop run's getting absorbed, and it's leading to some nice sell side liquidity coming in. So when you see sell liquidity coming in behind that, you might fancy maybe taking some sells against that stop run. Yeah. So it's all about trying to figure out what is it doing in certain locations into these areas. Then you can see that running into these ideas here, you can see that this, what is this here? Well, it's not a stop run. It doesn't look like a stop run area. So what is that? It looks like it's somebody going for the squeeze trade at the top edge. So when I look at that as a possible squeeze trade at a top edge there, then you can start to look at that and say, I think we're going to squeeze. And sure enough, you then squeeze. If we started to see a Voltic indicator coming in here, you'd say, well, wait a minute, that's a seller coming in behind the squeeze. And you could start working the Voltic on the sell side away from that price area. So it's all about then putting, what is this? It's likely to be a stop run, isn't it? It takes out that flat bottom edge there. It's likely to be a stop run. It's obviously the breakout trade on the stop run rather than the market maker's real liquidity, because it's usually going to be 2 or 3 ticks lower than that. But that's just taper in there, isn't it? Taper. If we had a big buy candle on that in terms of liquidity order book, you'd probably look at that as a real good opportunity to bid for this, for a gold buy coming away from that price. We could take that price higher at that stage, right? So when you're looking at things like Voltics and stop runs and all that, it's just about speed of, it's just about the speed of price moving into and out of an area. It's nearly always going to be high volume. When you look at anything that has a high rate of refresh on the limit order books, or a high limit of refresh on the actual market orders, you're going to have exactly the same. You're going to have high volume candles. So volume and tick and limit order book a lot of the times actually are very, very similar. You know, if you look at all the ones that have high tick count and you look at the ones that have high volume, they're nearly always going to be the same candles, aren't they? So therefore, there has to be a direct link between high volume and high tick count, because you can't have a high tick count if you've only traded 10 lots, correct? The maximum tick you're going to have is 10 ticks, right? 10 lots, 10 ticks, 10 ticks of volume. Whereas if you've got a very, very strong number of prices heading into one price, the volume is going to, by default, have to be a lot higher. So you'll find that it's nearly always exactly the same as volume, but not always exactly the same. Nearly always exactly the same as volume. So it's nothing special. It's nothing unusual. It's just effectively a good way to read, some volume narratives. Anyway, talking about a good way to read some volume narratives, I've just managed to get a little bit of real big premium sales on bonds there. The reason why we had to be careful was because it was on an uptick. So we have to make sure we're getting that exact premium price this time. So if the 0.4 would have been a reasonable proposition, did anybody start offering 4s? Because we're on an uptick in terms of the curve, you cannot do twos. You can't do twos. So when we're looking at that top edge bond, what a trade, by the way, guys. We went from 0.4 to 0.4, so we did get that $1,000 live in the room, guys. What a trade for you guys to then look at and say, yep, that was a live call. That was a live classroom discussion. We just went for $1,000 to fours. Anyway, what happened at the top edge in terms of the curve? Well, let's take a look. Let's remove the logic for a second. So you can see that the curve is now equal to the curve here. But because the curve is on an uptick just now, we've got to be aware that it's not the curve that's flat and the bond is on an uptick. The curve is on an uptick, so that's going to keep a lot of pressure into our bond price. But we are on an uptick at the moment, so we can look at this as an idea. The highest price was obviously a little bit higher, but obviously we've got a closing price here, but that close was higher. So it's difficult to get a great read on exactly what price we're using. So I just used the 212s. Based on the 212s, if I could sell fours, if the red line is not higher, would that be a reasonable trade? Probably at that stage, right? So we traded fours. I don't want to trade twos. I don't want to trade ones. I don't want to trade zeros. If I can trade fours, I'd be starting to get into an area that I quite like. Now, the reason why I'm not going to sell any lower is because the break-evens weren't actually that good at that stage. We were starting to see some evidence. You can see from equities, for example, we've got a very strong piece of evidence on equities for that top edge sell. So that's a great narrative. But obviously we have to be cautious because of what reason? We have to be cautious because of the oil break-evens. We're just making that extra little bit of a lower low. So we've got to be cautious with this trade. So what have I got to do because oil's making a lower low? What have I got to do, guys? I've got to determine whether oil is a sell or a buy still at those lower low prices. If it's neutral, I can sell bonds. If it's still a sell on oil, I probably shouldn't be selling bonds, correct? So what happened on oil? So here's the oil chart using exactly the same narrative. There was a previous low right there. And there was a previous low value right there. The value hasn't gone any lower. So when the price breaks the low here on oil, am I going to be a seller of oil at this lower price here, yes or no? Because this is what determines whether I'm going to take that bond trade. This arrow here determines whether I'm going to take a bond trade. So what would you guys say? Would you sell that red candle there, yes or no? Reeve says no. Is Reeve right? Now that's going to confuse everybody because somebody might say yes. And then I'm not going to know whether you're answering yes to Reeve being right or answering yes to the fact that you would sell the bottom edge of oil. You know what I mean? Anyway, you're not going to sell the fecking oil. I'll just answer it for you. So Jimmy, would you? Jimmy's answered. Jimmy's covered himself. Jimmy's covered himself. So that's all right. That's a good answer. But you can see that nobody's going to sell oil at that price. If the value was lower, the answer would be yes, I would sell oil. But because the value isn't lower, the answer is no, I wouldn't sell oil. Would you sell oil at higher prices? Yes, I would, but you've got to get higher prices before you can sell oil. If you're going to get higher prices on oil, that means you're going to get a drop-off in bonds. So the oil price is not a factor. So when I'm looking at this is all that I'm reading. This is a storyline that now makes sense to me. I want to sell top-edge bonds, and I've got a premium, and I've got a curve that supports the break-even storyline. And what happens next? Well, not very much, to be honest, but it's certainly not going to lose us money, is it? We got down to a low print of 24s, which is all right. That's all right, mama. That'll do. You can see that obviously we're getting a bit of a drop back off on equity, so it might well press back up. So at that stage, you're going to do what? Well, you're going to start bidding for this as a partial exit here and take some nice profits at this stage and see if we can start generating a little bit more of a premium again. If this goes higher, then you'd expect to be able to take the bond price up a little bit for a new selling opportunity. Look at that, guys. Live in the room. Crystal clear. Technicolor. $1,000 bond trade. Recorded live by Kim. Should be kicking herself if she never got that one, wouldn't she? Seriously, a live trade call for $1,000. It's like Kim's dream come true. Marketer's dream come true, isn't it, guys?